Okay, so here, this is going to be the lecture that we would have done together in class this upcoming Tuesday, the week of Thanksgiving. I know I mentioned being hopeful that I could get this out to you all by Wednesday or Thursday of last week. As you may imagine, with 7 kids, the things that I'd like to get done and the things that actually happen are often quite a bit different than each other. So I apologize for that. I hope that you all will grant me a little flexibility, and I will be sure to do the same for you all throughout the class as well. So basically, the only difference of what I will do in this lecture versus what we would have done in class, this would have been the first component of it, and then for the second part of class, we would have spent time working through problems, going over this material, which I could walk through some problems on this stuff as well. But since I did that for the first real lecture that covered chapters out of the material that we wanted to cover last week, since I gave you all that material online, the walkthrough, I decided I didn't want to do 2 walkthroughs of the questions online in a row, just because I think that's the most important part. So we will start with that the week that we see each other again. We'll walk through questions on 4, 5, and 6, and I will make sure that once we're done with that walkthrough, everyone is caught up and we are all on the same page as far as what we understand. That will kind of serve as our basis for financial accounting. And then throughout the rest of the class, we'll discuss some managerial accounting concepts, and then we'll try to apply all of that stuff to healthcare in the healthcare environment, which basically means nonprofit rules and how that changes things and what's similar and what's different. So we'll go from there. So I guess, and I'll send an email out that describes this as well. But I'm also, I should mention this as well, going to make it so this upcoming Tuesday, the time that we don't meet together in class, nothing will actually be due that week. I think I had that explained differently last week, but I won't have anything due that week. That would have been just your preparation for class, basically, is what was due. But since we're not meeting together anyway, there's no reason to have that due Tuesday. So basically, that preparation will be due, plus watching this lecture that you're hearing right now will be what's due for the following Tuesday when we get together, plus the quiz that was going to be due before class. I won't make you guys do that or have that done by Tuesday. That will just need to be done by the next time we see each other. And again, I'll put all that in writing as well, but I thought I'd throw that out here if you hadn't seen the note before watching this. Okay, so we're talking right now about completing the accounting cycle, which basically just means, okay, what are the final steps before we go through and start doing all of the recording process again. Closing entries are just the tools that we use to close out and reset temporary accounts. Income summary is the name of a specific account that is only used in the closing process, but as its name implies, can also be used as a tool to give us our basic summary of net income or net loss for the period. We've talked a little bit before about the difference between the balance sheet and the income statement. Balance sheet being a snapshot of the basic accounting equation at one point in time. The income statement being a view of essentially performance of operations over a given period of time. And the cumulative effect of every year's income statement is basically what's captured in the balance sheet. So all of the balance sheet accounts are kind of where our cumulative accounts are that we would always be tracking and need to keep an ongoing, you'd never reset these to zero. This would be like your cash account. Obviously, if you have a bank account right now in your personal name, when it comes January 1st, unless you take all your money out, you don't want that to be reset to zero. That doesn't make any sense. But revenue and expense, it makes sense to reset those to zero, because what those accounts really mean is revenue for this time period or expense for this time period. And then when that time period ends, you need to reset it and start over with the next time period. So how does that look? And I'll show you I'll jot down what this looks like here real quick. Okay, get a black pen here. So if I just to give you an idea, typical expense journal entry might look like this. We would have a debit to, let's say, rent expense. Sorry for the horrible handwriting. And then we would have a credit to cash. Let's say that was for $750, $750. Okay, so that is what the original journal entry looked like. So as time passed, these expense accounts went accumulating these debits in them. So money was going into the debit side or the left side of these accounts. And that shows that the expense is going up for that time period. Okay, so at the end of this is ongoing throughout the year. And then excuse me, sorry, I've got a bit of a cold going here, so try not to cough into the microphone too much here. Okay, and then that tracks it during the time period. After we have captured this expense for the time period, we want to reset it. We want all of these debits to go away in the rent expense account. So all of these are going to now become credits. So my closing entry would be a debit to this income summary account and a credit to rent expense. For, in this case, we only had the one transaction for $750, so that's how much the amounts would be. Let's see here. And then on the revenue side, as you were, well, let me change the color here. Let's make it prettier, sorry. Alright, so ongoing revenue. Okay, so as you're going day to day, collecting revenue for your company, this would be like a debit to cash, credit to sales or sales revenue, some type of revenue account, oops, for that same amount. Okay, so debit to cash, credit to sales revenue, 500, 500. Those would be the journal entries that you put in as time was passing throughout the year. And then at the end of the year, these credit journal entries that we put in as time was passing would be the ones that we were wanting to reset. So, I think I've mentioned this, but in accounting, one of the purposes of having these debits and credits versus just having an account balance is you're never just erasing anything, right? You always want to track exactly what's happening. So when we take, when we are getting rid of these numbers, you can't just erase them. They have to be going somewhere. So as we are effectively turning these account balances back to zero, the effect of that is still getting captured somewhere. Like over here, that's captured in this income summary account, the effect of closing that. So that will eventually carry over to the permanent accounts. And over here, on my revenue side, if I want to close the account, since it has a credit balance right here, I want to do a debit to that account, sales revenue, and the credit would be to this same income summary account. Okay, so in that income summary account, the credit side will capture all of my revenue for the period, and the debit side will capture all of my expenses for the period, just based on doing these closing entries. And then the owner's withdrawals, this right here, is not an income statement account, but it is a temporary account, and we want that to so because it's not an income statement account, it does not close to this income summary account. So in other words, as I reset it, when I do the opposite entry to reset this owner's withdrawals or withdrawals account, instead of it going to income summary, being where that is captured, instead of that, it just gets closed straight to owner's capital. And basically, this income summary account will eventually also end up in owner's capital, or the effect of it, I should say. But right now, the withdrawals account is closed straight there. So as the owner was taking money out of the company during this time period, that would have looked like this. Whoops. Debit, owners, withdrawals, credits, cash to the company. So let's say that was 100, 10, since that's all fit on my screen, and 10. So that's as time passes, and then as I go to close that, I want to get the effect of this debit back to 0. So I'm going to need a credit to owner's capital, or I'm sorry, owner's withdrawals. For 10, and the debit side is owner's capital. Okay, so that's what that looks like. All right, next slide. Post-closing trial balance, we've talked about what a trial balance is. Again, trial balance is just list all the accounts out, list if they have a debit or a credit balance. So over here, post-closing trial balance, cash, accounts receivable, and then we have debit, credit, and lines going down. And I would say cash, okay, that has a $100 credit or debit balance, accounts receivable, $50, etc., all the way down, listing out all of my accounts. Why do we do it? Well, that second bullet point there, oops, that right there, total debits and credits must be equal. So this is just a way of checking to make sure that after you did those closing entries, everything still looks good, you didn't screw anything up, debits and credits still all equal each other. So that's just an example of what that looks like for this company. Okay, so this probably should have been the leading slide for this slideshow, but this is the infamous accounting cycle. So the statements or the steps in the process that we were talking about here are 8 and 9. But we've basically talked about all of these steps, with the exception of the reversal. That's just a complication that, as non-accounting people, you don't really need to worry about. It's an accounting technicality. But yeah, so the purpose of financial accounting and the accounting cycle is, of course, to provide accounting information to outside users of it. So this is just a way of documenting all the financial events that have occurred within a company and making sure that we have usable information that we can compare a company's own performance against itself, and also a company's performance against other companies. Okay, so just some terminology here. Classified balance sheet organizes assets and liabilities into some of these various important subgroups that provide other, the organization of which, I should say, provides extra information to users of financial statements or outside users. So we've got current and non-current assets separated typically just by that year mark. Are they going to become cash within this year or not? Or essentially, do we plan, if it's a non-cash item, do we plan on keeping it in that condition and not selling it for longer than a year? In that case, it would be a non-current asset versus a current asset. On the liability side, same deal. Is the amount, whatever we're owing to someone else, is that going to be due within the next 12 months? Or if your operating cycle is longer than that, which operating cycle just means that the entire process of essentially getting customers, providing whatever it is you provide to them, collecting the money, and starting the whole thing over again. So you can think an example of someone whose operating cycle lasts longer than a year. Anything where, like, some big ticket item like space shuttles or something, where the actual building of the space shuttle itself probably takes longer than a year. So obviously getting a client, providing them with what they want, building it, getting paid for that would obviously be much longer than a year. But typically for most businesses, current, non-current just means, is it going to be, for the liability side, is it going to come due within the next year? And on the asset side, is it able to, or essentially, is it going to be turned into cash or liquidated within the next year? Yeah, we just talked about what current assets are. Long-term investments would be assets that are held for investment purposes, but again, that 1 year with the caveat of if you have a longer operating cycle, still holds true there. Plant assets would be the items that you're holding for non-investment purposes, basically longer than a year. These are going to be essentially your equipment, machinery, buildings, land, everything you use in the long term to produce whatever it is that you produce. Intangible assets just means you can't touch or hold or feel them, but they're long-term resources that help business operations. Just basically share that characteristic that they lack physical form. Examples of this would be patents, trademarks, copyrights, franchises, and this kind of amorphous term called goodwill. We talked about what current liabilities are, long-term liabilities, and again, I've explained this repeatedly, but it bears mentioning again. What is equity? Equity, again, assets equals liabilities plus owner's equity or equity. Equity is the owner's claim on assets. What does that mean? Well, if you turn all of these assets into money, okay, and you use that money to pay off the people who have a claim on that. Well, the order of that payment is first creditors, second owners, and that may be further subdivided into, if you're talking about stockholders, this might be preferred stockholders versus common, and it could be further subdivided than that as well. But the main subdivision is first creditors, second owners. Well, guess what? If you're an owner, you fit into this category. So with this cash, we'll pay all of our creditors off. Whatever's left over of that cash, we get to distribute to the owners. So owner's equity should track constantly. If at the press of a button everything was liquidated, or I shouldn't say liquidated, but everything that we own or everything else that's on the balance sheet is instantly turned to cash, and then we distribute that in the order of who has the best claim on that, or who has the preferential claim on that. Again, first we pay off our creditors, and whatever is left goes into the owner's pockets. Okay, so you can see why that makes sense. If you increase assets without increasing liabilities, and you didn't decrease assets to make that happen, then that is extra money that is going to go into the owner's pocket at the end of the day if you have to liquidate. That's basically kind of, what revenue is talking about. The effect of that is, okay, that's more money that's going, or more claim on company assets that's going to the owners because we generated more assets without incurring any extra liabilities. Okay? Hopefully that helps a little bit more if you still weren't grasping that concept. And like I said before, we've got some of these ratios in here. Current ratio is a very common one used to help determine whether you're going to be able to meet your obligations in the near future. And it's just, okay, using the definitions of current assets and liabilities that we talked about, just put one over the other, assets over liabilities, and that will give you an idea of how much of the assets on your balance sheet are available to pay off those current liabilities. All right, so we're going to move into a new topic here since we've gone through the full accounting cycle. Well, actually, let me back up real quick here. I didn't quite cover it all. One thing I didn't talk about, sorry for jumping around here, but I thought there was another slide. Right here. Let's see if it'll give me back the stuff I had on here. All right. So we talked about the process of closing these accounts, and I told you, for revenue and expense, we left one step out here. And it's slightly beyond the scope of this class. I'm not going to ask you to know how to do this or anything, but I don't like to mention it without telling you exactly how this happens. But basically, we've created this account called income summary that we used only for the process of closing this account. And then obviously these are just numbers I made up, so these might not look like reality at all. But if this were reality, and these were my closing entries, this one, let's see, right here would have been the revenue closing entry, and this would have been the expense closing entry. Okay, and the part of those that I'm concerned with, obviously, since this is the income summary account, I'm concerned with the part of these two closing entries that talk about income summary. The debit side was $750. The credit side was $500. Okay. So that's my income summary account. But I also mentioned that the income summary account itself is a temporary account. So while it sits in this account, it does give me a little bit of useful information. It tells me that the side, in this case the debit side, which is capturing expense for the period, and then the credit side is capturing revenue for the period. Okay, so that should sound familiar to you because that is what's on the income statement, right? Revenue minus expense equals either net income or net loss. Well, in this case, you just have to look at the income summary account, and if you have a credit balance in there, then you've got a net income for the period, and if you have a debit balance on there, then you have a net loss for the period. Well, I have a debit balance of $250, so that's going to be a net loss for this period. Okay, so but that can't just sit there in this income summary account, because next year or whenever I go to do financial statements again, I'm going to have to go through this reset process, and the income summary account needed to start at 0 so that it accurately captures expense for just this period and revenue for just this period. So in this case, I need to get rid of this $250 that's sitting on the debit side of income summary, and I also want the effect of that to show up in some permanent account. Okay, so the way that I do this is with a journal entry, and in this case it would be a credit to income summary to close that. Whoops, sorry. My mind's going faster than my hands here. Credit to income summary, $250, and that wipes out the balance, resets the account. And then the debit side of this will be what captures the stuff that was sitting in income summary. I need to capture that somewhere on my basic accounting equation in the permanent account. And depending on what my ownership structure is in the company, this is, I guess I should just say, this is going to go into an owner's capital account of some sort. If this is a publicly traded company with shareholders, this would actually, this would go into an account called retained earnings, which just captures basically the cumulative effect of net income or net loss over a company's lifespan, essentially. If this was just a single owner, this could just go straight into owner's capital as well. Okay, so that is how the effect of these temporary accounts, revenue and expense, we talked about when we discussed the account types that go into the basic accounting equation. We said revenue and expense don't follow those rules because they're temporary accounts, so they don't both, even though the effect of them is located on the right side of the basic accounting equation, they don't follow those rules about carrying debit and credit balance the right way. The reason for that is because they go together to form this the income summary account and eventually go over to owner's capital. So obviously, depending on whether it was more debits or credits, more revenue or expense, this will either be a debit or a credit to owner's capital, depending on how that performed over the period. All right, so let me skip forward here, back to where we were. Okay. And now we're talking about accounting for merchandising operations. So merchandisers, well, I guess I'll go through service companies first. A service organization sells the time of humans, usually. These are going to be like your service firms, like an accounting firm, lawyers, doctors, who are selling their time to you, the value of their time doing something for you. Those are service organizations. Merchandisers are entities that don't make anything, but they sell products. So these are going to be like your big box stores. Some of them actually do make some of their own products. Like Walmart has a Walmart brand. But for the most part, like a Walmart or a Best Buy, stores like that, who just buy products from someone else at wholesale and then sell them either at a higher priced wholesale to someone else or to the consumers at retail. Those are going to be your merchandisers. So that's what we're talking about when we talk about merchandisers. And why do we separate that out? Well, the nature of providing service and making your own product is substantially different from just buying and selling, just based on some of the different accounts involved. Obviously, someone who's selling time versus selling products, one has to worry about inventory where the other doesn't, and that's a large accounting concern. So that's why we separate those out. And then merchandisers, if you're making your own products, that complicates what you carry in your inventory even further. So we separate merchandisers, those that buy and sell products, from those who make their own products to sell to someone else. So how do we come to net income for a merchandiser? Start with net sales. From that, we subtract out cost of goods sold. From that, we get to gross profit. We subtract out other expenses. These are going to be expenses not captured within cost of goods sold, so expenses that were not captured in inventory when you purchased the item. And that will sum to net income. What does the operating cycle for a merchandiser look like? You'll start with making purchases. Those go into your inventory. From there, and it doesn't have to be credit sales, but you make sales. If they're credit sales, that becomes an account receivable from which you have to collect cash, and then you start over again. Obviously, if it's not a credit sale, then you would just skip that account receivable step and go straight to the step of selling product and straight to making cash. Okay. So as far as accounting for inventory, we start with our beginning inventory, and then obviously any purchases that we make during the time period. Net purchases, net purchases just means, obviously if we make purchases but send some of those back, anything that we kept would be the net purchase. Add those together, that will be our merchandise available for sale. And between that, merchandise available for sale, any items that we sold during the period would show up as cost of goods sold, and whatever is left that we didn't sell, those amounts would show up in ending inventory. When we talk about inventory, like I said, that's kind of one of the key components that separates merchandisers from manufacturers. But there's two main types of inventory systems, or categories, I should say. Really, this perpetual system is what gets used almost everywhere now. Periodic is only used in either a scenario where we're really adverse to technology, or a really simplified environments where you have really small inventory, it just doesn't make sense to go to a perpetual system. But basically, perpetual system, think barcodes, think every time you scan something at the register, it's immediately pulled via the computer reading the barcode. It's immediately pulled from inventory, and your system knows every time a sale is made exactly what is still left, or what should be still left in the store, assuming no theft or damaged goods, etc. What should be left and what should be sold, and instantly transfers those costs from inventory to cost of goods sold for those products. So it's do you have everything up to date instantly, or do you have to send someone out to physically count everything to determine, okay, well, since there's 50 of these left, that means I must have sold X amount of items, and that's how I keep track of what's in my inventory. So obviously you can see how perpetual being the up-to-date system, that makes life much easier, but you can see how that could also lead to a much larger set of expenses if you have to implement and set that system up. This is what just the purchase of inventory looks like. We have an inventory account, merchandise inventory, and another inventory account, cash, and we're just trading another asset account, cash, and we're just trading one asset for another. We've got some of these items called trade discounts. These are a trade discount is basically where we've got our catalog price, and then we've got what we actually charge most people. So catalog price or MSRP, one thing, actual price, something else. The difference between those two would be considered a trade discount. We want to distinguish those from what we have called a purchase discount, which is basically just a way that we have of incentivizing people to make payments, cash payments earlier on their accounts payable to us, which would be accounts receivable in our eyes. So we give them, hey, if you pay within 10 days, we'll give you a certain amount, 2% or whatever, 3% discount on your purchase. This is, if you have a purchase discount, this is the way it's written most of the time. That would be read 210 in 30, and the 2 just means you get a 2% discount if you pay within the next 10 days. Otherwise, or basically whatever's left after that, inclusive of what you paid in that 10 days. So whatever's remaining outstanding on your bill must be paid within the 30 days. So anything outside that 30 days would be late, whatever that means. This is not telling you what that means. This is just telling you if you pay within 10 days, we'll give you, or you only have to pay 98% instead of that full 100%. Whoops. Yeah, this was just that same initial entry we made before, but now instead of cash, we're paying with an accounts payable. But we've been offered these credit terms where if we pay within 10 days, we get a 2% discount. If we take advantage of that and pay within those 10 days, then we've got the full amount being debited in accounts payable, $1,200, and that will show this accounts payable that we initially made. This is the initial entry. That will reduce that to 0 fully. But at the same time, we don't want $1,200 of cash coming out because we're only paying 98% of the full amount. So we show 98% of that coming out of cash, and the difference is just us reducing our inventory account. Remember, when we purchased this over here, we increased inventory by $1,200. Well, we don't want that to be $1,200 anymore. We want that to reflect what we paid in cash. So we're reducing the debit balance in inventory we're reducing that by $24 by crediting that account. So now, after this journal entry, the balance in our inventory account will match this $11.76 that we're actually paying out in cash. So it reflects the actual amount we paid for this item. So this is just showing you a T-chart or T-account version of what these look like. And you see here, after those journal entries, the account payable balance is 0, which is what we wanted, and merchandise inventory accurately reflects the amount we paid for that. Returns and allowances, obviously these are occurrences that will happen. Return means they're sending the product back to you. Allowance just means, hey, they said, hey, this was broken, and you said, we don't want to worry about you sending it back, just keep it. That would be considered an allowance. So what does this look like? Well, again, this is from the perspective of Z-Mart, the buyer. So I had originally, if I'm Z-Mart, I had originally purchased some product. I've determined that $300 worth of that is defective. So I'm basically sending you a debit memorandum. This is basically just a memo, a note saying, I'm not paying you this $300 because these were defective. Okay. So the journal entry for that looks like this. We're reducing accounts payable by $300. So that means, hey, we're not going to pay that $300 after all. And again, same amount is reduced out of merchandise inventory to show those costs no longer in merchandise inventory. Okay, so just another scenario here. Purchase $1,000 of merchandise on June 1st. Those are the terms. So this is that journal entry. We've got credit terms there, so if you pay within 10 days, 2% discount. Otherwise, have to pay within 60 days. 2 days later, we return $100 worth of the goods. So without even worrying about the discount, we just want to reduce this amount by 100. So essentially, we're just doing the opposite of the initial journal entry, taking 10% of that away by doing the reverse, where you saw a credit here, make that a debit here, where you saw a debit here, make that a credit here, and that just lowers both of those accounts by that amount. So now what we have left over is $900. It's as if this original entry was for $900 instead of $1,000. Still have the same terms. So the next part of that is, okay, within the 10-day period on the last day, you take advantage of the 2% discount on the $900 remaining balance. So the full $900 that's left in accounts payable is now reset to 0. And just like before, we show 98% of the full amount as what we pay in cash. And the difference between that 98% and the full amount, that's how much we reduce the merchandise inventory account with that credit entry of $18. Another important issue is when we're talking about inventory for merchandisers, who owns the inventory when it's being shipped? So if you give it to FedEx or UPS or whoever, some trucking company, to get it to your buyer and something happens to the truck, who should suffer the loss? That's an important component. But also, if the truck happens to be driving on December 31st or whenever you're doing financial statements, how do you account for that? Is that something you own and so it should be in your inventory? Or is that something that's already been bought and is owned by the buyer and should be captured within your cost of goods sold? Well, it depends. You've got these two options here, FOB shipping point and FOB destination. And these would be mutually agreed upon by buyer and seller. So if you did shipping point, then as soon as the goods leave the shipping point, then ownership changes to the buyer. Okay, so as soon as it's given to the carrier, ownership changes hands right here at the shipping point, and now the buyer owns it from this point on. So it would be part of buyer's inventory as of right here. So if January 1st happens during the transit, then buyer owns as of December 31st. Okay, if it's destination, then this is what you look at. This is the cutoff point, and everything before that is owned by the seller, and the seller pays the costs of shipping it, and also would include anything that the truck has in the seller's inventory at the end of the year, if that occurred. So if these journal entries over here show you what the journal entry looks like from the buyer's perspective under shipping point, because the buyer is the one who's going to have to pay for that, so it becomes part of the inventory cost to the buyer there. If it's the seller who's paying for it to get shipped under destination, that would mean that the seller owns it up until this point. It arrives at the destination. And so if you're the seller, this is what that journal entry looks like to you to account for the cost of selling. So, example of that, Z-Mart made a purchase, FOB shipping point. That means ownership changes hands at the shipping point, and it also means Z-Mart pays for that cost of the freight at the shipping point. We talked about what that journal entry looks like: debit to merchandise inventory, credit to cash. Okay, so when we're calculating the total net cost of merchandise purchases, this is essentially everything as a merchandiser that's going into our inventory account. That is all of these items. Nets to this amount, and that would be what goes into inventory. Then as a merchandiser, how do you account for merchandise sales? Well, these are the various components. Start with sales, get rid of any discounts, get rid of any returns or allowances that you've issued during that period, and that nets out to what's called net sales, which is sometimes used for some financial ratios, so that's why we separate it out. From that, we will net out cost of goods sold, which captures most of the regular costs associated with getting your goods to the point where they're available to sell. This is everything that would be in your inventory account, then just becomes cost of goods sold at the moment that those items are sold. When we sell something, we have this kind of dual-pronged components, these two components that we are needing to track. So that means whenever we make a sale, we've basically got these, it often looks like just one journal entry, but it's actually kind of two separate entries. We've got the first entry up here that is kind of, I like to think of it as tracking kind of the retail side of this, where we're showing what the customer either paid us or owes us. And so this is what we earned on this sale. This is our revenue. So you see a revenue account here. It's sales. This might actually be called sales revenue as well. Typically we'll have the name revenue in the name of it if it's not sales. And this would either be a debit to cash or accounts receivable or notes receivable on the debit side there. And then on the other side, this is the entry that is basically tracking kind of the cost to us. So this is what gets these items out of our inventory account and makes the cost appear on cost of goods sold. So up until this point, anytime we spent money on our inventory, it doesn't show up as a cost. It's just transferring one asset, cash, to another asset, inventory. Not until we sell those items do they become costs, and that is when they get captured in this cost of goods sold account. So you can see just by making this just by making these two journal entries, we can see kind of how much profit we're generating on each on this sale, because right on that journal entry we're tracking both the amount we're getting out of this from the customer and kind of what it costs us to get it to the point of being able to sell there. Sales discounts are basically, we call them a sales discount, but they're basically a way of incentivizing credit-based customers to pay in a more timely manner. Let's see. Yeah, this is kind of just comparing the scenario of taking advantage of the sales discount versus not taking advantage of it here. So if they don't take advantage of it under this method of accounting, this is kind of the standard method of accounting for this. We don't even fuss with the discount here. We just say, okay, we expected to collect $1,000 when we made the sale, and when we collected $1,000. So that's all we needed to do. We reduced accounts receivable. We showed cash coming in. So that's kind of the assumption, is they're not going to take the discount. Then if they do take it, well, then we have to do something special, and that's what you see down here. Okay, they took the discount, so we're going to show cash coming in is less than it was originally going to be. We thought we were going to get $1,000. Instead, we got $980. We want the full $1,000 to come out of accounts receivable, because otherwise we're going to be, after hounding them for more money. So we do want that to be reduced fully. And to balance this out, we got to capture that $20, that 2% somewhere. So instead of reversing it back out of the sales account, because initially we recognize this as sales revenue, so it would kind of make sense to say, well, okay, we're getting rid of, we're collecting less cash than we said we were going to up here. So shouldn't we reduce sales by that amount? Well, yeah, we do want to reduce sales by that amount, but instead of backing it out of the sales account, for a number of reasons, most of which involve financial ratios, but for a number of reasons, we want to have a track of the total gross sales that we made before we applied any discounts to that. So we're going to keep track of this number, this $1,000 kind of separate. We're not going to reduce that at all. But when we're tracking the overall effect of that sales revenue, we will actually say, okay, this was our sales revenue minus our sales discount. So this sales discount is actually called a contra revenue account, and that means, hey, whenever we show our revenue account, we'll also show this other account discounts underneath it, and it will say less sales discounts, so that it will net together to equal the amount of cash we actually picked up from that sale. And the same thing occurs with these returns and allowances. So in this example, Z-Mart's sale for $2,400 had a cost of $1,600. And the returned items, returned items that are going back sell for $800 and $600. Or I'm sorry, sell for $800 and cost $600. So of this $2,400, we're basically saying the items coming back retailed for $800 and cost us $600. So when we're recording that we're bringing these items back to us, we've got two components again. We've got the part that records the retail part. So we're going to show amount we're hoping to collect is down by $800. And again, this is where we could have sales going down by $800, but we want to keep track of the total amount of sales we made, even though we took some of the returns or allowances out of that. So instead of debiting sales directly, we have, again, this contra revenue account, similar to discounts, that will show up underneath our sales revenue account and be netted together with that. And then we just have a direct reversal of what was initially reporting our costs. Initially, that was a debit to cost of goods sold and a credit to merchandise inventory. But the amount that is coming back, it just gets reversed back out of that. So this is, again, the case of an allowance instead of a return coming back. And you see that in that case, we don't need to show it coming back into our inventory or reducing cost of goods sold at all. It still has to get captured in that cost of goods sold because it's still going to show up as a cost there. But we do want to show accounts receivable coming down. And again, sales revenue will be coming down in effect by putting this money into this contra revenue account. This is just a kind of flow chart of some cost flows during the accounting cycle. So yeah, I guess we already looked at this in a kind of a one-year scenario before, and the only thing to note here is at the end of the year, whatever's in ending inventory comes over for this year's balance sheet. Whatever's in cost of goods sold for the year shows up as the main expense account on the income statement, and also whatever's in ending inventory, in addition to going on the balance sheet, obviously since that's a permanent account, that's also what will start in beginning inventory for the next period, and we'll go through this whole cycle again. All right, so I'm going to pause here for a moment and divide this into kind of a two-part lecture.